Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser of Victory Fiduciary, and welcome to what's going to be the last Wednesday in September, if you can believe that we are just already approaching October. It's kind of hard to believe, and so a lot of things we want to get into today. But first, I do want to let you know that I can officially say that I am an Ironman after I did Ironman Maryland last Saturday, and I know many of you have been following and have been asking about my progress throughout the year. And so if you're not familiar, it's a 2.4 mile swim, a 112 mile bike, and then a 26.2 mile run. And so I had started training for that back in January, and I was able to successfully complete the race in the amount of time that I was able to finish under that 17-hour mark. And so just wanted to kind of give you that bit of news. So last week was a little bit of recovery week. I'm still a little tired, but feeling much better than I was feeling last week. So happy to be here, happy to be able to kind of get into some of the things we're seeing within the market. And so number one, what I just, we've seen a lot of ups and downs in the market, especially since last week. If you'll remember, last Monday, the broad-based markets all really kind of moved into some corrective processes. And so from start to finish, we saw about a 5% decline in markets beginning early last week, kind of began a little bit the week prior to that towards the end. Although by the end of last week, you wouldn't have known because we were actually almost approaching all new highs again. And so it was a fairly kind of consolidated, short-lived correction. And so what we're seeing, though, even today is kind of more of the same, and I'm going to show you specifically, but for these indexes today across the board are selling off. NASDAQ is down almost 3% right now. S&P is down 2% for the day so far. And if you've been following along, you know that historically September is a weaker month for the market just in general. If we just look at statistics, September just tends to be weak. And so we're kind of living up to our name right now. We tend to see more volatility. And honestly, in terms of volatility, it's been a fairly quiet year. I hate to use that word, but we really haven't seen a ton of outside days. And outside days is any time markets close above more than 1% or below negative 1% for the day. We haven't seen a whole lot of that. So what we're just seeing right now, it seems to be some choppy trading, some other exogenous events that are kind of adding to that. Last week was just concerning news coming out from China. And so we saw kind of that sell-off last week, although then investors kind of shook that off. And so what we're really seeing today is, number one, concerns of Treasury yields spiking again. We saw a pretty big spike in Treasury yields, and anytime those go up, typically then the valuations of stocks will go down. And that is really, right now, kind of, we're seeing that coincide. So that means inflation is likely, rising. Now, is it transitory? We've been talking about transitory inflation since February. And so, we have that, combined with the fact that there's an impending government shutdown, and are we going to be able to get some party cooperation across the board so that we can go ahead and get past what we need to, so that we don't have this temporary shutdown. Energy prices are continuing to rise, which again just causes increasing prices that kind of coincides with inflation. And so these are all kinds of things that seem like they're kind of spooking markets, particularly in the growth and the technology spaces. These are the areas that always really get hit hard in terms of when we see rising inflation. So don't be surprised to see growth areas and tech areas specifically today really being kind of cut back. You see that evident today as the NASDAQ is down about 3% today for the day, and that is really growth and technology weighted. Something else that came out this week is just that consumer confidence index kind of tracks how we feel in general about businesses, how growth is going, and then what is the perceived expectations for 6 months moving forward. And kind of all across the board, the perception was worse than it was the year before. Likely that's because we see COVID cases, rising, and I think people maybe in the back of their minds are a little concerned about, what's that going to mean if businesses either aren't able to be open at 100% capacity, or if just people aren't comfortable with that, what will that mean? So these are all things that have just been kind of weighing on investors this week. Although I will say that what we have been saying, really for quite some time is that markets are overvalued, overstretched. And so it's kind of like these pauses, these breathers are necessary. And so we kind of always know when we're getting to that point of extension. I can even show you in a few minutes where when we look at relative strength, where you can kind of almost say, okay, it's got to be coming. We just don't always know why or what the trigger is going to be. And so for today, it seems to be those rising treasury yields signifying the potential for continued inflation. But what I want to show you, number one, is when we look at relative strength, just trying to find those areas, those like sweet spots of where we want to make sure we have allocation areas allocated towards, particularly within sectors. And so right now, when we look at areas of strength, financials is actually the only area right now that has a higher, like stronger relative strength than the S&P 500. S&P 500 has kind of been top dog for the last couple months. Nothing had a better relative strength than the S&P, and then technology had leapfrogged over S&P. Financials was right below it, but now kind of with these corrective processes we've had the last week, tech has kind of fallen below the S&P, and then financials has leapfrogged over both of them. So we see financials, the S&P 500 index, technology, and then some of these other areas, small cap, mid cap. Something interesting that we had been looking at for some time, and that we've actually wound up acting on not too long ago, was real estate. We've seen real estate kind of move all the way. It was kind of all the way down at the bottom here, and it's really been kind of moving up fairly rapidly. So we actually did, in some of our models, we did add a little bit of exposure to real estate based upon some of the movements that we were observing in here. But just think every now and then it's interesting to kind of show where are those areas of strength within the market, and also where are those areas of weakness. And so right now what I'd like to do is go to these technical charts here and just kind of show you what's actually been happening, and then also kind of show you that it actually maybe it was not as great of a move as maybe as it felt last week. And so first we're just going to look at the NASDAQ. Now remember, this blue line here is our 50-day moving average. It typically acts as a line of support. We've shown multiple times where we've kind of come down, sat down on that 50-day and bounced right off of it. So last week we did actually close below the 50-day. That can be a sign of more significant weakness. Good news is though that by the end of the week we had closed on top of it. And so then typically that we're kind of allowed to like overlook that then once we kind of close over top that again. And so let me show you something here. So way back last week, we were sitting in a relative strength of 70. That's a very overvalued, overstretched short-term number. And so you can almost kind of see like every time we've hit 70 or come close to it, we have some corrections here. So here, again, here we were, no surprise, and we had that correction there. Now the good news is that means we still have a little more room to kind of run, because we're sitting at like just under 50 right now for relative strength. Again, just kind of, it's interesting to be able to kind of like see that in real time. So NASDAQ particularly has been hit, because remember, today, last week, areas of growth and technology were really affected, and today particularly because of inflationary concerns that we're seeing with those treasury yields. But honestly, the S&P 500 looks fairly similar to what we just saw. So same idea, 50-day moving average. You can see all these areas where we've kind of sat on the 50-day and kind of bounced right off it. Now this one, we violated the 50-day a little more pronounced. But again, the good news was that by the end of the week, we were able to close back above it. Now today, we will likely close underneath that 50-day again, just being that we're 2% down for the day already, and today is Tuesday, by the way. I'm recording this a day early. So, we'll see what happens, but it's likely that we're going to be very close to that line of support there. Same idea, though. You can see we got very overstretched. We were just under 70, and then we saw that correction. So when we see that again, remember, it's just kind of that short-term like warning. We don't ever act on these short-term RSI numbers, but it tells us, hey, we are really overvalued, overstretched. Probably we're going to see some sort of a breather. Sometimes it's a breather of just, not even 0.5%. Then other times it's more significant. Again, from start to finish here, we were down about 5% total, but then by the end of the week, it was kind of like it was a blip on the radar, and like it never even happened. So really interesting how, and again, if you'll remember, this time last year, September and October led to a 10% correction. So 5%, this could have been all that we're going to see between now and the end of the year. But I think it's likely that we need to expect that we could absolutely continue to see some more volatility until we kind of head into that end of the season. Especially September, October also just tend to be those weaker times of the year. And so I would say from a technical standpoint, though, nothing completely out of the ordinary that we're seeing right now. We're seeing in terms of relative strength in those areas of movements that we're seeing, nothing that really had us kind of surprised or scratching our heads, kind of like the moves that we would have expected to see. And so that's really what I wanted to kind of just discuss today is, again, today we're having another down day. What's going to happen tomorrow? I'm not sure. So it'll be interesting to see if we do close below these 50 days, it'll be important for the market to be able to climb above that and kind of close above that by the end of the week. So we'll have to kind of see what happens. Again, all eyes and ears are still kind of on the Federal Reserve, who's really been hinting at the fact that it's going to have to start tapering. It's going to have to start limiting some of the qualitative easement that they're doing and their bond purchases that they've been doing. They're going to have to, but what they're doing is they're also leaving it open, saying that they're going to have some flexibility in terms of if they need to scale back or do a little more depending on market situations. So they're really kind of telling us that they'll kind of do what they need to do to kind of keep things moving. Wouldn't be surprised, though, if we hear that in November that they are going to move forward with some sort of a taper at this point. So we'll have to see, especially if inflation continues to run hot, if they think that this inflation that we're beginning to see maybe isn't so transitory, they're going to have to do some things to scale that back. And so we'll be waiting to hear certainly from Federal Reserves, as well as finding out, if and when the government's going to be able to, pass what they need to be able to extend our budget for the rest of the year so that we don't go into another short-term shutdown. These are all things that investors are looking at. All in all, as always, we are keeping an eye on things. If anything changes, anything that's really important that we think you need to know, you can come and find that out here. And otherwise, beginning in the fall, we're planning on coming back to every week doing these updates. And so we're really glad to have you here. Again, I'm Ashley at Victory Fiduciary. Any questions at all, email me at ashleyr@victoryfiduciary.com. I love to hear your comments, your questions, and maybe even feedback or thoughts for our next video. So hope you have a great week, and we'll see you soon. Thank you.